Welcome back to our Introduction to Bonds presentation. In this presentation, we will take a look at the various types of bonds. Now, we're not going to get into a whole lot of detail, folks, because we've already said that bonds are pretty boring. And when you get into the details, it gets even more boring. But it's excellent material if you have insomnia at night. Yeah. Not as bad as the accounting. Remember, we're going to insult everybody by the end of the semester. And then we'll take a look at some bond ratings, the way we rate bonds, which is really kind of interesting, and end with discussion of bond quotes. So we'll start from the most safest, least riskiest, bona fide, established bonds, and those are Treasury bonds on slide 25. Treasury bonds, notes, T-bonds, notes. I know, remember, if it's a 2-year, 5-year, 10-year Treasury note, everyone I know and me and I call them bonds. So don't confuse these with Treasury bills. Now, Treasury bills are the short-term investments we discussed back in chapter 1. They don't pay interest the way regular bonds pay interest. You buy them at a discount and then they pay you back the face value. So you might have bought it for $990 and 3 months later they give you $1,000. No, these things pay interest every 6 months. And then at the end of the period, you get your $1,000 back. Now, the tips in Treasury inflation protected securities have become very popular now that inflation is raising its ugly head as we come out of the self-induced coma of COVID and have a war in the Eastern Europe. And we'll discuss those on another slide. And then agency bonds, which are not direct obligations of the United States Treasury, technically don't have the same weight as Treasuries, but are considered, or were always considered, very safe with almost no risk of default. And indeed, when the organic matter hit the ventilating device after the home debacle of the mid-2000s and the mortgages that were tied to the homes, we'll go over it. And yeah, you and I are now proud owners of Fannie Mae and Freddie Mac. And remember, we said that muni bonds are not taxable at the federal level. Well, the same thing is true of Treasury bonds. They are not taxable at the state and local tax level. Feds can't tax the state and local governments. The state and local governments can't tax the feds. So, slide number 26. Tips in Treasury inflation indexed obligations. These have become very popular, and now people are scrambling to buy them. You would have bought them last year, you would have done a whole lot better than buying them now, because they're a type of Treasury security that provides protection against inflation by adjusting investor returns for the annual rate of inflation. So initially, they pay less interest than other Treasuries. But the par value, remember the $1,000, is adjusted upward each year to keep pace with inflation. Therefore, the interest payment goes up every year as the par value increases. Now, what's the downside? You must pay taxes on the interest and the income, and the interest and the increase in the par value. It's called phantom income. You didn't get that increase in cash. They didn't send you a check or put that money in your account at the brokerage firm. But your value of your bond has gone up, and the IRS says you have to pay taxes on that. Phantom income. Ugh. Of course, if you had it in a retirement account, that wouldn't be an issue. And as we said, before inflation started ticking up, these things were a pretty bad deal, but now people are clambering over each other to buy them. Mortgage-backed bonds, agency bonds, pass-through certificates, participation certificates, collateralized debt obligations, collateralized mortgage obligations. What are these things? Well, look, these entities, you might have heard of Fannie Mae, Freddie Mac, and no, Fannie Mae is not a candy company, Ginnie Mae. They were sponsored by the Congress many decades ago to help create liquidity in the mortgage market. That's a fancy way of saying making it easy for people to get loans to buy houses. And even though they were sponsored by the Congress but not part of the government, even though they were private entities, very profitable, you could buy stock in them, there was this implicit thought or feeling or idea amongst investors that if anything bad happened, the Treasury or the Federal Reserve Bank or somebody would come to the rescue. And the Congress people said, no, 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 these are private entities. We're not going to bail them out if the organic matter hits the ventilator. Well, of course, it did in 2008 because they got caught up in the mortgage crisis like everybody else. They were lending out loans to people who had no business whatsoever getting these loans. And then when the first Bear Stearns and then Lehman Brothers and the dominoes started to fall, well, Fannie Mae and Freddie Mac were in the line of fire too. So the federal government came to the rescue, and now you and I are proud owners of Fannie Mae and Freddie Mac. And believe it or not, they're actually producing a ton of money for the Treasury. Every quarter, they send over billions of dollars to the Treasury, and this is in a country that hates, or says it hates, socialism. But everyone can agree that this is not the best of all situations, but nobody can agree on how to change it, how to fix it. There are various ideas that are floated about, but they usually get shot down very quickly. So it's one of those situations, if it ain't broken, right, don't fix it. So we'll see what happens. Stay tuned for further developments of Fannie and Freddie. Now, how do these things work? Let's go to the next slide. Before Fannie and Freddie, you were a potential homeowner, homeowner, and you went to your bank or credit union or savings and loan, which they're all gone, and you got a loan, and then you bought the house, and you made the payments to the bank or the credit union, and life was simple. That's how it worked, right? And no, that's not how it works anymore, dear students. What happens now? There's this entire mechanism, this entire industry. Yes, you go to your local bank or your credit union, and you get a mortgage. But immediately, that bank or credit union turns around and sells the mortgage to Fannie, Freddie, Ginnie, Mae. And then why? Well, then they can turn around and make another mortgage, right? And so you keep making the payments to your bank, but you think you're making the payments to the bank. You are, but the bank is now just turning around and sending the money to Fannie and Freddie, right? The bank is now just servicing the loan. They're not the loan. They don't own the loan anymore. They're not the loan owner, as the things were before these entities started. And so what does Fannie and Freddie do? Well, they don't sit on the money. They turn around and bundle the mortgages into bonds that are sold to individuals and institutional investors all around the world. And so what happens is investors buy the bonds and they receive the pass-through payments from the homeowners. And some individual investors buy these bonds, and then the mutual funds and pension funds and life insurance companies, they buy the bonds. So when Fannie and Freddie were in deep kimchi in 2008 and 9, these people were not too happy. The mutual fund managers and the individual investors, and they were sweating bullets until you, the proud citizen and taxpayer of the United States government, came to the rescue and are now doing okay because Fannie and Freddie are making a lot of money and passing it on to the United States Treasury. Yeah, it's the way it works, folks. Get involved in the mortgage industry and learn all about it. And it's one of those, we talk about one of these positions in the industry, a mortgage broker, and then there's dozens of other positions in the mortgage broking industry. It's a fascinating and lucrative position. So think about it. They need you. Slide 29. This process is called securitization. It's the process of transforming lending vehicles such as mortgages into securities, into bonds, into investments. It can be done with any asset or debt, such as bank loans or leases or other assets. So this has spread into the world of what is called asset-backed securities. So the ones we just looked at were called mortgage-backed securities. Well, the home is the asset. But there are other assets that we can do this with. Car loans, credit card loans, patents, stocks, and bonds, and even artists. Even artists. David Bowie, you've heard of him, right? He shocked the financial world by creating Bowie bonds. He said, look, I'm David Bowie, and I want to borrow, I think it was $55 million, which is, a lot of money to you and me, but in the bond world, that's, small change. But still, to lend, to buy bonds from an artist, he said, look, I make a lot of money as an artist, and I'm using my artistic works as the asset that is backing this security. And it turns out that they paid back. People who bought David Bowie bonds, I think they gave a pretty good interest rate, all got paid back. So there are other artists followed suit. Collateralized bond obligations, structured investment vehicles, they go by various names. So would you buy a bond that's backed by an artist? Think about it. Next slide. Municipal bonds. Okay, so those were the Treasuries and the associated agency bonds. Muni bonds are bonds that are issued by states, counties, cities, other political subdivisions such as school districts and bridge authorities, water authorities. Most all muni bonds are tax exempt from federal income taxes. The IRS doesn't like that term tax-free, so they want you to use tax exempt. If you got any capital gains from the sale of your bonds prematurely because interest rates have fallen, well, those are not tax exempt. And you have to be careful. If you are subject to the alternative minimum tax, and not many people are, but more and more every year are, some bonds are not tax exempt. I don't know how the Congress pulled that one off, but they're not tax exempt for the AMT. And the AMT is this whole other world in the tax world. If you are, if you are affected by it, because the IRS sent you a friendly little letter saying, you screwed up, you owe us an extra $4,000. Muni bonds are very popular with individual investors, especially high income and high net worth taxpayers. Yeah, I remember when the Proposition a.a. bonds were coming out, and the Z bonds, and one of the governing board members were saying, we need to advertise this to our South Bay community, and so they can invest in Southwestern Community College. And I was in the back going, no, I think I don't. No, who buys these bonds? Yes, the very wealthy, high-heeled individuals. Some muni bonds are insured, which is obviously a desirable feature. There are basically three types of muni bonds. The two most popular are the general obligation bonds and the revenue bonds. GOs, general obligation bonds. These are municipal bonds backed by the full faith, credit, and taxing power of the issuer, which means that the entity, city, county, state, whatever, has to go out and tax more if the bonds get in trouble. They have to go out and do whatever they can. There's a cute little story about San Diego, which was labeled Enron by the Bay almost a couple decades ago. In the 1990s, they made some very dubious deals with the unions to get the union backing a pet project by Mayor Golding, Susan Golding, yeah. So the unions were offered this sweetheart deal, and they said, okay, we'll take it. And of course, by that time, Mayor Golding and the other members of the city council were long gone. By the time the chickens came home to roost, as the saying goes, and so none other than the New York Times did an article on San Diego's stupidity and called it Enron by the Bay. Well, the new leaders said, well, look, unions, you have to claw back these deals we made with you. The union said, wait a minute, no, you signed the contract. And the leader said, well, if you don't, we're going to go to bankruptcy court. It was pure bluster, because if they did go before the bankruptcy judge and said, we're in bankruptcy, judge, the judge would have said, yeah, you are. You haven't even begun to tap into the taxing power of San Diego City. And needless to say, they worked it out and didn't declare bankruptcy. The next category are the revenue bonds. These are muni bonds that require payment of principal and interest only if sufficient revenue is generated by the issuer. And these are typically, the hospital bonds, the bridge bonds, the water authority bonds. They are typically less desirable than general obligation bonds. So they're going to pay higher interest. But as I said, I'm not too keen on bonds. I don't really have that much experience with them. But people who I trust say, oh no, they like revenue bonds. They do their due diligence just as you would be looking at a company, a corporation, a stock, to see if they're going to be able to generate the money to continue to pay dividends. You would look at that authority, be it a school district or well, not a school district typically, but a hospital or a bridge or a water authority, to see if they were going to be able to make your payments, because you're going to get paid higher interest rate. Cool. And then the school districts, that's who relies on this special tax bonds. That's the school districts. That's what I was talking about, the Proposition R, the Z, the A bonds. These are muni bonds that are paid from the proceeds of a special tax. So we, Southwestern Community College, went to the voters of the South Bay and said, hey, we're Southwestern Community College. We need to fix up the campus. It's about 60 years old now, and some of the buildings are in need of being repaired and replaced. We need new buildings. Will you allow us to borrow the money? And people don't really understand what they're doing. They vote yes. Yeah, they like schools. They love us. Thank you very much. And now the special tax will be community something, not funding district, community facilities district. I forget what CFD stands for, but they will now be paying an extra amount on their property taxes for 30 years to pay off the bonds. Do you think people really understand that when they say, yeah, I want to have more schools and a bullet train, and I want more emergency medical facilities and another hospital? You got to pay the money back. Now, what are some of the advantages of muni bonds? Well, as we said, the big advantage is that they are free from federal income taxes. What we're going to learn in our next chapter is how to compute the taxable equivalent yield so that we can compare apples to apples. You can't look at a muni bond and a corporate bond without computing this taxable equivalent yield to see if they're equivalent. And if you are a citizen of that municipality, for us, California, then the state will usually waive, WAIVE, forgive the income tax on any bonds that you buy in your municipality. So it doesn't matter where the bond is in California, up and down the state. If you're a California taxpayer, California resident, you're not going to pay California income tax. Now, you're not going to pay any federal income tax. That's true of any muni bond, unless you are subject to the AMT, and some bonds are subject to if you're subject to the AMT, some bonds you have to pay tax on. So this is very cool for high net worth, high income individuals in their state. The higher the tax bracket of the investor, the higher the taxable equivalent yield, as we'll see in our next chapter. Capital gains, on the other hand, are never tax exempt. That's a whole different situation. If you sell your bonds before their maturity at a gain, you have to pay capital gain, just as when you sell a stock at a higher than what you bought it for. It's the same idea. Okay? Now, those were muni bonds. Next step down the ladder of risk versus return are corporate bonds. And within the corporate bond world, there's this whole pecking order of secured and unsecured. Now, if you took financial planning and money management, we talked about secured credit cards and secured debt and unsecured credit cards and unsecured debt. Same idea. Secured corporate bonds are usually some kind of mortgage or collateral trust bond that is based on the assets that the corporation owns, airplanes, railroad equipment. So if the company goes bankrupt, you have first claim to these assets. And then, of course, there are junior secured bonds, which means that you're next in line, right? Like a second mortgage on your home or home economic credit. Then the unsecured bonds, debentures, I've heard it said both ways. I'm not really sure which one it is. These are like a credit card. They are backed by the full faith and credit of the corporation. So if the corporation goes through bankruptcy, then you as an investor get in line, and after the senior bondholders of secured bonds are paid, then whatever's left over, you get to pick at the carcass. And then after you're done, then the stockholders are there. And just like the revenue bonds, there are income bonds that are unsecured, requiring that interest be paid only after a certain amount of income is earned. So again, you would need to do thorough research to see if this company is going to be able to earn the income necessary to pay the bonds. What's the advantage? You're going to get paid higher. Obviously, the less risk, the secured bonds are going to pay less interest than the unsecured bonds, and the income bonds will pay the most. So there's risk versus return yet again in action. Now, we really shouldn't discuss these in polite company, but junk bonds. We've discussed non-investment grade bonds, or have we? I think we have. Yes, when we discussed mutual funds. Junk bonds are high-risk securities, high-risk bonds that have low ratings but can produce high yields. Now, junk is a pejorative term, isn't it? It's not a very nice term. The proper term is non-investment grade. You might also hear people call it high yield or distressed or the speculative bonds. You might hear people say. They are issued primarily by corporations, but there are some municipal junk bonds, and traditionally they were reserved for bonds that were in distress. You just didn't want to talk about these things in polite company, right? Junk bonds. But in the 1980s, junk bonds became an entire industry as companies not large enough to issue bonds began to issue bonds with very high interest rates. 17%. Oh, I mean, that's just insane now. But that's what was going on. And, some people thought this is ridiculous. And other people thought, no, what a great opportunity. 17%. Well, guess what? Exactly. Some of them went through bankruptcy. In fact, there was a publicized case of one company, Drexel Burnham Lambert. You can look it up. They're long gone. And a gentleman by the name of Michael Milken, who was saying junk is good. These companies, they need this capital and they're willing to pay these high interest rates. And sure enough, he was doing hanky-panky with another gentleman by the name of Ivan Boesky. They were actually using a motel chain based here in San Diego called Vagabond Inns as their front for insider trading, and they were the two gentlemen who spawned the movie Wall Street and the famous speech where the guy, I forget his name, says greed is good. It's taken almost verbatim from Ivan Boesky's speech at some graduation somewhere. So these are very high risk bonds, but they also offer the opportunity for large capital gains as well as high income, because junk bonds tend to follow the stock market more than they follow the bond market. And we're going to talk about this more when we get to diversification and asset allocation. But because they're based on companies that are in distress, if the stock market's doing well, that usually means the economy's doing well, and these companies are able to pay the high interest rate that they promised to pay. If the economy does poorly, the stock market's going to do poorly, and the companies are not going to be earning what they were earning before, and so the junk bonds will do poorly. Interestingly, as we'll discuss later on in more detail, bonds tend to do well in a recession, assuming the company don't go bankrupt. But interest rates fall in a recession, bond prices rise. So we're going to discuss this sort of it's called negative correlation between stocks and bonds later on, and that's why diversification is very cool. That's the whole chapter 11 in 30 seconds. My apologies, but we'll come back to it later. But do you want to invest in junk bonds? In my humble opinion, no. I mean, everyone's different, but I like boring. If I'm going to invest in bonds, I want boring bonds. But I also want higher interest rates, so can't have everything. Slide 35. Now for something completely different. Zero coupon bonds. Now, I want you to study this, folks. You need to know this. You're the investment guru for your friends and family. So if anybody comes up to you and says, what's a zero coupon bond? You can't go, oh, Tano told me what it was. I can't remember. You have to study it. These are bonds that have no coupons. Remember the coupons? Well, no bonds have coupons anymore. But before we went all electronic, bonds had coupons, and that's how you got your interest payments. But if there's no coupons, that means you're getting no interest payments. So they're sold at a deep discount to their maturity, kind of like a savings bond, remember? So instead of receiving interest in cash, the bonds simply accrue, there's the word we use in the accounting world, in value until maturity. So for example, if you had a 6.25% bond that matured in 20 years, you would buy it at the issue time, when it was issued, for $300. Now, after 10 years, it would be worth approximately $550. And then after 20 years, you would get your $1,000 back. So for people who really aren't interested in the income, but want to grow their nest egg, they want to accumulate assets, these kind of be cool, right? Very cool, because you know you're going to get 6.25%. What's the disadvantage? Well, they're very sensitive to interest rate changes, exhibiting wide price swings, but what do you care? If you're not going to sell it, you don't care. But the IRS expects you to pay taxes on the accrued interest even though you didn't receive it in cash. There's that phantom income again. You see? So you didn't get the money in cash. All you saw is your bond increase in value. The IRS says you have to pay us taxes on that. So what do people do? They put them in a tax sheltered account such as an IRA, or you buy muni bonds that are zero coupon bonds because you're not taxed on them. Very interesting. But we're going to ask you in the assignment about zero coupon bonds, so make sure you've studied your zero coupon bonds, okay? Okay. All right. Slide number 36. How are we doing? Now, what about foreign bonds? Obviously, the United States is not the only country where we have bonds. Well, in general, up until just several years ago, people just did not want to invest in bonds outside the United States. But as we've said, when more countries have much higher standards, some have better than the United States. But you have a problem when you put your money outside the United States, and that's the currency risk. So to attract United States investors, some entities, most notably, you might have, most of you are too young for that, but Argentina got in a lot of trouble for doing this. They issued US pay bonds. So they said to the United States investors, sure, you can lend us money in dollars. We promise to pay you back in dollars. So no matter what happens to the Argentine currency, we're going to get our money back. Well, when the Argentine currency collapsed, Now Argentina is saddled with this huge debt that they can't service because their currency is not worth anywhere near what it was. So it takes tons and tons and tons of more of their currency, and they had to refinance, and it was a big kerfuffle. This was back in the 1980s, but it's happened throughout the years. There are fewer and fewer of these. Why? Because there are more and more investors all around the world who are willing to take on those bonds and not demand that they pay you back in US dollars. So if you're one of them, if you're one of the investors who's willing to change your currency into yen or into euros or into pesos, you can buy bonds outside the United States. There are international brokerage accounts, which makes it fairly easy to move your currencies around. But you have to remember currency fluctuation risk. If the dollar rises relative to the foreign currency, all other things being equal, and they never are, the value of the bond will fall. Vice versa, if the dollar falls relative to the foreign currency, the value of the bond will rise. Now, the dollar has been very strong for many years. I don't expect it to stay this strong, but doesn't mean I'm right. Doesn't mean I'm wrong. That's why they call it the future. But right now, I think investing abroad is actually not a bad idea, assuming the world doesn't blow up with Mr. Putin. But if you're so inclined, but what do most of us grunts do? We buy our foreign bonds through global or international bond mutual funds because the bond mutual fund managers, they have the resources. They have people all around the world speaking various languages, doing the research that we just really can't do sitting in our room with our laptop computer. So that's my story, and I'm sticking with it. Now, next, let's discuss bond ratings. So those were the types of bonds. Go back over, study those, make sure you are vaguely familiar with them because there's a whole lot more detail that we're skimming over. Why? Because I just think it's too much detail for beginning investors, and it's too much detail for me too. Because bonds are boring. They're supposed to be boring. Slide 37, bond ratings. Now, when you and I go to a bank, credit union, and ask for a loan, they have a system that calls up your credit score, right? There are three super bureaus, Experian, Equifax, and TransUnion. And they keep track of us, and they see if we pay our bills on time, and they give us a number. Well, it doesn't work that way in bonds. There are agencies, the two largest being Standard & Poor's, remember them, S&P 500, and Moody's, and then there's Fitch's and Weiss and a couple other places. They keep track of the various bonds, and they rate them. They give them letter grades, as we'll see on the next slide. I have always thought of these as the idiot lights on your dashboard. Now, I am not a motor car fan. I don't really know that much about cars. But the way I always looked at it is when that red light came on, don't bother, just keep driving. You only got a couple more miles before the engine seizes up anyway. But that's not what my friends who know about cars say. No, pull over right away. Pull over right away when the idiot light comes on. Your oil light or the engine is hot. Pull it over. But so in my case, I think of these rating agencies as just idiot lights. By the time they've downgraded the bond, it's too late. If you're holding it, you're toast. In the wake of the 2001-2002 corporate scandals, the rating agencies were caught completely off guard. They didn't downgrade Enron and WorldCom until they were practically in default. So they were giving them a investment grade. They were junk. They were investment grade, the lowest investment grade, but still investment grade. But it turns out that it was a total fraud. And so by the time they downgraded them, it was too late. Everybody knew that your bonds are worthless. They were again called to task because of the 2008-2009 mortgage-backed bond crisis. They were giving these liar loans, mortgage bonds. People, all they do is sign their name saying, yeah, I'm making $100,000. Are you going to verify that? No, we're not going to verify it. You're making that right? Well, not really. Yes, you are. Sign here. Yeah. And they were giving them the highest rating. And they screwed up again. Now, when they were called in front of Congress, Congress said, do you realize you almost brought down our entire economy? How dare you do this? You obviously were being paid to give them the best rating, which is what they were. They actually get paid to do that by the bond issuer. And the company said, oh, how could you think we would do such a thing? They get away with it. What are you going to do? It ain't perfect. Nothing's perfect. So here they are, dear students. Here are the bond ratings. AAA is the highest grade. AA, and then BBB. Now, BBB is the lowest investment grade. Anything BBB or above is the investment grade bond. Anything below BBB, BBB, CCC, CCC, and then D, there's no F, is bad, junk, distressed, speculative, high yield is the nice way of saying it. Because once you get down here, folks, the CCC, D, it's just, forget it. It's gone. It's already destroyed. So I always wonder, what is the difference between AA and A and BBB and BB? Reminds me of eggs. You go to the store and these are grade B eggs. These are grade A eggs. What's the difference? I don't know. You'll have to ask Standard & Poor's and Moody's. But that you need to know this, right? Anything BBB or above, AAA, AA, BBB, that's investment grade. Anything below BBB is junk, non-investment grade, speculative, distressed. And by the time you get down there, it's too late. Just keep driving because your engine's going to seize up pretty darn soon. And then slide 39, the rating agencies further fine-tune their ratings by adding a plus sign or a minus sign. Moody's goes 1, 2, 3. So you got AAA, AA plus, AA minus, A plus, A minus. By the way, Southwestern is actually AA minus. Now, what's the difference between AA minus and AA? I don't know, but I think it's kind of silly. I'd much rather see numbers, but I'm not in charge, so it ain't going to happen. This is what we're stuck with. And when you go to the quotes, you'll see the bond ratings. You'll see bond ratings next to the quotes for the bonds when you look up your bonds. Speaking of quotes, slide number 40. Bond trading is very difficult for retail investors. Trading volume is often thin. Most bonds trade over the counter. Now, what does that mean? That means you've got to find somebody, or your broker has to find somebody who owns the bonds, who's interested in selling. And for many years, and still, there was a newspaper, I think it's all online now, called The Bond Buyer, where people would put in bonds that they were interested in selling, bonds that they were interested in buying. But as we said, they don't want to talk to you unless you have $25,000, $50,000 for a single trade. So you're not going to get treated very well. Sorry. However, the exception is treasurydirect.gov. At treasurydirect.gov, you and I can buy one bond and get the same price that the big boys and girls on Wall Street get. So very cool. And that's why we asked you to investigate treasurydirect.gov, because when the government does something stupid, we want to jump up and down and scream and holler at them. And when they do something pretty cool, we want to say, thank you, good for you, attaboy, attagirl. And so let's now take a look at bond quotes. Here's one last curveball they're going to throw at us, folks. Wouldn't it be nice if they just told us how much the bond cost in dollars? No. They are quoted as a percentage of par, and they don't put the percent sign down. So you'll see 97.25. What does that mean? 97.25% of the par value. Most par values are $1,000. So, and again, we said in this class, they will all be $1,000. So you just move the decimal point one to the right. 97.25 means $972.50. Got it? 97.25 is a bond quote for a bond selling at a discount. A bond selling at a premium would be quoted above 100, and a bond selling at par would be quoted at 100. Now, there's not too many places that will give you free bond quotes. And as we said, people who buy bonds $25,000, $50,000 a trade, they usually have their own private broker. But it appears that FINRA is the Financial Industry Regulatory Authority. They're the nonprofit organization that oversees brokers and the brokerage firms. They went to Morningstar and said, Morningstar, we need some bond quotes. Morningstar said, all right. But if you go to Morningstar.com, you can't find the same website. I don't know what's going on. But what can I say? That's what we're going to use. We're going to use FINRA. So on the website, you'll see FINRA and bond quotes. So check that out. Cool? So check out the bond quotes. That's part of your assignment. And realize that if you see 97.25, just move the decimal point over, $972.50. Okay. And that is our introduction to bonds. So go back over, study the different types of bonds, know them about as much information as you see in the presentation, and make sure you understand the credit ratings, the AAA, AA, and then you're going to do some bond quotes for your assignment. It's pretty easy once you play around with it. It's pretty boring. They're supposed to be. They're bonds. But when we come back in chapter 9, you're going to see some excitement, something that's going to look familiar. The discounted cash flow model for bonds. It turns out that bonds really are boring because it's nothing like what it was for stocks. It works the same, but it turns out that because bonds are boring, because they're fixed, the predictions that we create with the model turn out to be very, very reliable. That's why we buy bonds. They're stodgy, they're boring, but they're reliable. See you in our next chapter when we discuss bond yields and bond valuations.